Good afternoon, everyone. Today, I would like to do a recap of one of the topics that we covered this semester, financial statements. According to International Accounting Standard number 1, a presentation of financial statements, it is a requirement that all the registered companies produce a full set of financial statements. A full set of financial statements will include statements like the income statement, which is formerly the profit and loss account, the statement of financial position, formerly the balance sheet, the statement of cash flows, the statement of changes in equity, and the notes to the financial statements. Let me give you a brief background of these financial statements, starting with the income statement. The purpose of an income statement is to measure the performance of an organization. This is where the organization measures its performance in terms of profitability. That's where we calculate our profit or loss. And it's one of the most important financial statements because it shows whether the business is making progress or not in terms of profitability, which is very important for its stakeholders. The second financial statement that I'm going to talk about is the statement of financial position. The statement of financial position is more of a mirror reflection of our accounting equation. The accounting equation whereby our assets should equal capital plus liabilities. So the balance sheet, what it is actually showing is that the capital that was employed in a business, how was it used? It is reflected in the assets that was acquired by the business for its operations. Therefore, the capital side of the balance sheet, that is the equity plus liabilities, should always equal the assets. Because if we put in a certain amount of money in the business, and we are saying this money was used to acquire the assets that the business have, therefore, we should not have any extra money that is going to remain apart from what is reflected as the assets. The third one that I'm going to talk about is the statement of cash flows. A cash flow statement is very important, as you know that when we are preparing our income statement, we use the accruals basis. The accrual basis allows us to include in the calculation of our net profit items like depreciation, prepaid expenses, prepaid incomes, and you realize that these items, they do not involve the actual movement of cash. We may not have paid for an expense, even if we have incurred that expense. We may not have received cash from our debtors, even if we have earned that cash. And as we are preparing our income statement, all these transactions are taken into effect. However, when we are preparing the statement of cash flows, we exclude all the items that do not involve the actual movement of cash and only include those that are actual cash movements. The importance of this statement is that at times we can record huge profits as an organization, but when we go to the bank, our actual cash position may be totally different. The problem comes when our creditors all show up requesting their funds at once. We may not be able to pay off all our outstanding obligations because some of the monies we have not yet received them. And this is why the cash flow statement is more important as compared to the income statement. Then the third one that I'm going to talk about